Well, good day there, Wealth Press subscribers, traders, investors. It's another Monday morning roundtable, and I'm here with Adam Sarhan, Roger Scott, and Jeff Yasteen. Gentlemen, how are we today?
Excellent.
Well,
Excellent.
All right, guys, we're back in S&P record territory. Futures pointing higher. Everything seems to be more of the same, higher, and higher. What has changed? What's going to change this week? September is here. Roger, where are we starting this third quarter?
Well, I think one of the reasons why we're seeing this exuberance, which is what I'm calling it now, is because of the statements that were made by the Fed last week. The Fed was very, very clear that they are extremely vested, even if the economy goes, if the GDP shows that we're growing past 2%, which is really something else. If you think about it, it's kind of like, aren't you guys supposed to be just a little independent? Are you supposed to be a little more distant from the stock market? I mean, I remember Greenspan. I remember Fed in the old days, if you want to call it the old days, but they never even talked about the stock market. It was kind of like almost like something to the side that had no direct consequence to the Fed. But things are changing. There is no more non-relationship between the Fed and the stock market. That is just, I don't even think they can deny it with a straight face at this point.
Sure. Also, over the course of the weekend, I noticed across a bunch of mainstream media publications around the world, the Times London, Le Monde in France, New York Times, CBC Canada, there were articles promoting this concept of modern monetary theory, which seeks to normalize the expectation in readers that governments can borrow infinitely. Taxes do not need to be the foundation of revenue in the government case, and that central banks are perfectly within the purview of rational monetary theory to endlessly borrow money. And I thought, this is really weird. Suddenly, across multiple publications on the same weekend, where I've never heard the term modern monetary theory, except as a colloquialism of three words strung together, and here we are. Modern monetary theory means, obviously, our expectations about the management of debt in the context of a deficit are prehistoric now, are old-fashioned, and that if you want to be hip and get with the times, it's print money till the cows come home, and there are no repercussions. So, Jeff, I'm going to start with you on that. What's your reaction to that?
I would agree with you, and I would agree with Roger. I mean, I can remember even in the 80s, in the early 90s, and even I had friends, in those days, you didn't even know if the Fed was meeting or not. You would just see something come out on the wires. So we're definitely in a new era, if you will. And we've been slowly kind of stepping our way towards this. The thing that worries me, considering where the stock market is, the degree of exuberance that is out there is, the thing I always try to keep in mind from 2000 and 2008, the last two really significant tops, is the idea that Wall Street reserves the right to change the rules of the game. And they don't have to tell you about it until later, 6 months or a year later, when people start saying, well, why aren't my stocks going up anymore? I own 20 or 30 or 40% down or more. And I think we're seeing the beginning play for that in terms of interest rates. I think interest rates are going to start moving higher in reaction to modern monetary theory and this embrace that, hey, let's just go all out. Money is completely free. There's no need for any more fiscal or monetary discipline. Let's just go there, because obviously Powell is reflecting that very much so. Higher interest rates, I think we're going to see a spike in oil prices soon. And as all this comes to the fore, we're going to see this, this rotation from these high-priced tech stocks into other parts of the market where you can still get some interesting buys out there, real estate as well.
Mm-hmm. Okay, Adam, what's your take on the modern monetary theory, and how does it affect investors in their attitudes?
So I'm extremely passionate about the subject for several reasons. Number one, it's the most important factor that dominates the market. You've got fiscal policy, which comes out from central banks, and monetary policy from central banks, and then fiscal policy from Congress and DC. So what happens here, just think of the two big major drivers of stocks and all asset prices for that matter. So what happens is that the Fed sets monetary policy, and the Fed has a dual mandate. Their job, stated by their mandate, is to make sure employment stays in check and to make sure inflation stays relatively healthy, which is around 2% per year. What happened since 2008, we've had the new normal, the gradual recovery. The economy hasn't really grown in a normal recovery. It's been a very, very subdued and modest recovery. So what happened, the Fed hasn't hit the 2% objective in almost 10 years. So they're doing, I mean, their intentions are good, right? They don't want to cause harm. So with that assumption, sometimes they have unintended consequences to their actions, but their job now is like, well, hey guys, if we can't hit 2%, and gals, if we can't hit 2% per year, then let's use, and this is what with the big paradigm shift that happened last week, let's use an average target of 2%. Well, what does that mean? If one year they're short of 2%, the other year they can run over 2%, as long as the average is around 2%, they're okay. So what does that mean in plain English? In the old days, if it hit 2% or got close to 2% or even above 2%, the Fed would begin raising interest rates to curb inflation. That's gone. Therefore, with that, the practical implication of last week's meeting is that the Fed can keep rates as low as they want for as long as they want. Even if inflation goes above 2%, there's no longer a backstop that says, oh, the Fed's going to have to raise rates or be pressured or forced or whatever the word is that you want to use, because it doesn't matter. They took the line away. It doesn't matter. If inflation's over 2% one year, they keep rates at zero or wherever they want to keep rates or even go negative, whatever they want to do. There's no ramification because it's an average of 2%. 2 years, inflation's above 2%. Guess what? They'll just tell you, oh, it's our new normal. It's the average of 2%. So the fact is the Fed wants to keep rates low, translate that to stocks and other asset prices. That should translate for the foreseeable future, higher stock prices. But remember, the big caveat is it's a game of musical chairs. Eventually, all this easy money that's being injected into the system will end. And when the music stops, it might end extremely bad. And if it ends badly, then look out below. Because the other point, which you mentioned, was 2008. The big wording of the day was too big to fail. Well, now we're way too big to fail. We're even bigger. You know, back then, the five big investment banks are literally all gone. You had Merrill Lynch, which was eaten up by Bank of America, or essentially failed. You had Lehman Brothers, Bear Stearns, both gone. Lehman failed and Bear Stearns was gobbled up by JP Morgan. And then you had Goldman and you had Morgan Stanley. Morgan Stanley and Goldman are quote unquote still around, but they changed the commercial banks and no longer investment banks. So the entire investment banking model was disintegrated in 2008 because it was too big to fail. Now it's way too big to fail. What's going to happen during the next crisis? Nobody cares because it's not happening right now. Remember, the immediate gratification. So those are my thoughts on the great experiment, if you will.
Mm-hmm. Okay, so I mean, great. So from an investing perspective, should I be embracing the modern monetary theory, and I should adopt the expected perception as a member of the investing public that economic numbers no longer matter. I only need to pay attention to stock market numbers and put my money in the stock market. That's all I should care about. Is that basically what I should be doing, what we Wealth Press subscribers should be doing?
No, because at the end of the day, in the long term, fundamentals, the economy matters. I have yet to see an environment where you have a deep recession or a depression and the stock market goes straight up, no matter how much money they print. So, and look at the Japan. If you study history, you've seen this happen over and over and over again, going back to every major empire in history. Look at the Romans. How did they fail? They failed from within. Look at Japan. Japan in the late 80s, like we were just talking about in the 90s, had their Nikkei index, which was their stock market, at 40,000. I mean, that was a huge, huge move. Then it fell all the way down to this single thousands to 4 or 5,000. Now it's around 10 or 12 or somewhere in that area.
Spain
So-
too, just as sorry to interrupt you,
Hey, go
Spain
ahead.
as well, very similar thing happened to, yeah.
Yeah, great point, Roger. Spain has happened. I mean, it's happened over and over and over again. You can't print your way out of oblivion. I mean, you get to a certain point. Look at, I think it was Zimbabwe a few years ago where they had, I think it was a 15,000% inflation rate. 15,000, like you wake up one day for a slice of bread or a piece of, let's say, you know, can of whatever, Pepsi, a piece of bread, let's say costs $1. The next day it's at 15 bucks. The next day it's almost at 100. The next day it's at 5, so on and so forth. It's not sustainable. So once it's a game of, you know, the dominoes, once they start falling, if they fall, you're done. And then also you can't get out of that. Once Japan went into that, you know, the big crash, so to speak, with the bubble burst or whatever word you want to use, really it's been a zombie environment for decades. So that's usually how these big experiments end.
Okay, so let's talk a bit about the indicators that we might be nearing such a precipice. Roger, you've always got your thumb on the pulse of what's going on in that regard. Any indicators in the market that we're nearing such a cataract?
Well, first of all, before I get on this bandwagon, let me just say, Adam, I'm sitting here and I'm going, everything you've said, 1,000% on the ball, 1,000% on the ball. I could not have said it better myself. I mean, he was absolutely right. And yes, it is going to bite us in the butt. The question is when. But yes, I am seeing certain things. As a matter of fact, I'm seeing a technical environment that's extremely similar to what we saw preceding the February crash. I'm seeing the highs, momentum levels right now. We went to historic highs. When we went from historic lows in February, the crash took us to historic lows, and then we went to historic highs. Not one time in 20 years have we been able to sustain those levels without going to neutral. If that happens, that means all the NASDAQ 100 stocks have to go to the 200-day moving average. If that happens, the Dow Jones will probably lose about 10% of its value, okay? And that's something that will happen. It doesn't mean it's going to be sustainable. It's going to stay there, but just to relieve the pressure. Number two, we've had divergence between the RSI oscillator and price action on both the NASDAQ and the S&P 500 for 3 months now, exactly as it happened in pre-February, leading into February to that crash that happened in February. If you look at the examples, and I'm doing it every day in my VIP program, they literally are a carbon copy of each other. Now, something that before everybody goes and rushes out and sells every stock they own, keep in mind, there's two ways for momentum pressure to relieve itself. One, the market can cool off and go down, which is the most likely scenario in the next month and a half, especially pre-election. But scenario number two is momentum can relieve itself by simply congesting and maintaining congestion. So it doesn't necessarily have to go anywhere. This is why it's so difficult for traders to pick reversals. Pullbacks are easy, trends are easy, reversals are very hard because you can have a momentum level that's really high, just kind of relieve itself by things just kind of moving sideways for an extended period of time. Although, again, I don't think that's going to happen. So we've got divergence on the RSI. We have the South Korean KOSDAQ, which is the over-the-counter market in South Korea. If you look at it over the last month, it has been going down. It has also been diverging. If you look at the KOSDAQ and the NASDAQ next to each other, they literally mimic each other. They have a correlation of about 98%, which has not happened over the last 3 weeks. That's a big, big warning sign. So if you guys have a chance, take a look at the KOSDAQ, KOSDAQ, KOSDAQ. That's the NASDAQ, or that's the South Korean over-the-counter market, which is just like the NASDAQ we have here. We have NASDAQ here, KOSDAQ there. So we've got RSI, momentum levels, the 50-day, the 200-day, and we're seeing something that we haven't seen since February. For the first time, we're seeing a cool-off in the healthcare sector. As a matter of fact, I did a morning report today on 5 stocks, including I don't remember the ticker symbol. Let me look it up real quick here. I'll give it to you. But healthcare stocks that are cooling off, and we have not seen this cool off since February. Let me give them to you right now while I'm here, so investors can take a look. GlaxoSmithKline, GSK ticker symbol. Another one.
I noticed, Roger, I know, just to buy you time, I noticed like Moderna was down this morning, and it's been sliding for the last 2, 3, 4 weeks. And if anything, that seemed like an instant, slam dunk way to get rich stock, a month ago. And people got so hot on it that you can see where it just inevitably went down. Sorry, go ahead, bud.
No. GILD. So we're talking about GILD. That's Gilead Science, Glaxo. I mean, we're talking major companies, and there's 2 or 3 smaller ones, but this is the first time we have seen it. Even Regeneron is losing. To your point, Jeff. Even Regeneron is losing momentum right now, and has been basing for a while. And the healthcare sector, although it's still making new highs and it's going along with the S&P, there is cracks in the foundation. And I'm seeing more and more of those cracks on a relative basis, on a comparative basis. So the point I'm making is we may not be going down as hard and as fast as some may think, but the cracks are there in the foundation. And lastly, before I give the mic to someone else, put to call ratio. The put to call ratio, which is usually random, about 90% of the time, it'll fluctuate between 120 and 0.70. It's been, if you look at the highs, they've been really, really favoring the bulls, which has been, as I don't remember the term Adam used or you used, James, when the bullish market gets so big and people just keep. But you guys, you coined it a certain name, and I was like, I should use that as well.
Bought overextended?
No. It was when you started the conversation with the when you were talking about the philosophy of people not caring.
Irrational exuberance.
Irrational exuberance. Thank you. Irrational. I appreciate that. Thank you. Irrational exuberance. We are seeing a very strong irrational exuberance in the call buying right now. That call buying is just. It's just running rampant. The put to call ratio hardly ever goes to 0.65, it just stays there, which means the number of calls being bought is strongly overwhelming the number of puts being bought. And that's a reversion to the mean type of an indication. It's like a rubber band being stretched out. So that rubber band, imagine a rubber band goes from here to here. It's like this right now. I mean, that rubber band just, so even if we don't pull back, I'm looking for defensive sectors to start leading, like I've been saying for the last month and a half, basic materials, consumer staples, those are defensive sectors. I'm not seeing that strength continue, at least without a pause in technology and healthcare without a pause. Doesn't mean we're going to enter a bear market. It doesn't mean we're going down like we did in February. It just means that there are cracks in the foundation and that we may be moving a little too high, too fast.
Sure. Okay. Well, so in terms of indicators and defensive asset classes, I mean, I'm looking at gold has sort of surged and is starting to look like it's going to test its previous high of over $2,000 here, and silver, of course, accompanying it. The silver gold ratio narrowing slightly in this particular bull run, but also, it's interesting in juxtaposition to the COVID stocks or the large biotechs. Gilead is the maker of remdesivir. Remdesivir was modestly successful in the treatment of extreme acute cytokine storms, as they call the cytokine storms, rather, as they call the worst case scenario for a COVID infection. But at the same time, it's pretty undeniable that we've seen infection rates level off in the United States. It was 50, 60, 70,000 a week or a day rather in July. Now it's down to 48, 49,000. There are instances like in Spain where it has rocketed off to new infectious intraday infection rates. But in the US market, it seems like the perception is that, the COVID thing is, it's something we're just kind of getting used to now. And so maybe the COVID vaccine is not so important. Maybe COVID treatments aren't quite as important. And is that maybe underlying the sort of retreat from COVID stocks or from biotech sector more generally?
Well, is that a question? Well, let me just start off this question real quick. I have parents who are in their 70s, and I'm sure as other people on this broadcast do as well. And for the first time, and my wife's as well, we moved everyone to Florida a few years back. And for the first time, I'm seeing a change in attitude. I think it's a combination of things, James. I think it's a combination of people are just getting sick and tired. They're feeling a little better about it because it's not as rampant in the States. We're just becoming more kind of used to it being around. And I also think it's because we are seeing very few, as I talked last week about stocks that are in phase 3, like Pfizer, there's only a few stocks that are in phase 3. So that means what that means for the rest of the healthcare stocks, it's kind of like before everybody had a chance of making it. Every stock had a chance of being the right stock. But the closer we get to let's see who's got, show me the money time, there's only 3 companies. And out of those 3 companies, you got Pfizer, you got I mentioned them a few days ago, but there's only three. And the rest just don't have that. There's not enough market cap or enough reason for funds to invest money in the stocks that are not there right now. So I think what we're seeing is we're kind of seeing we saw a level of overexcitement hitting the biotech and the healthcare. And I think now the reality is coming to the front, and we now know where to focus. We're focusing on those 3 stocks with a laser tight focus, and the rest are just kind of going by the wayside. And I think that's going to continue till something is out. But I think it's a combination of things.
Mm-hmm. Okay, so a very high level and general discussion this morning. Adam, have you got some clear sort of picks that you could share with us today in the context of all that we've just talked about?
Sure. So I mean, Roger's point is spot on. There's 2 ways that the market can consolidate a move. So you had a big move up with these tech stocks and these stay-at-home stocks. The first way is to move down and correct or pull back, and the second way is to move sideways. So to answer the question directly is wait for these monster stocks or these alpha stocks to pull back and or consolidate their moves, because the future could be even brighter for these stocks, whether or not we get a coronavirus treatment or not, because these stay-at-home stocks have become the absolute winners, and the gains are just to mind-boggling. I mean, Apple and Tesla both announced stock splits today to make it more affordable for a broader base of people. Those 2 stocks are extended in the short term, but they still could have a very long way to go. Amazon, same situation. Peloton, same situation. So I like these stay-at-home stocks a lot, not right now, but on a pullback or a nice consolidation, because I think they have a lot more way to go. The other area that I would look at would be these beaten down biotechs that are temporarily out of favor. I think Gilead's a great stock. I think Moderna's a great stock. Another one I mentioned on the show a few weeks ago was that Zosana Pharmaceuticals. Again, one of my companies has a position that's up 60% since I mentioned it. Ticker symbol there is ZSAN. You have BNTX, which is BioNTech. BNTX. This is one that's partnered, the German company that partnered with, I believe it was Pfizer to help develop a COVID vaccine. Is one that's under, it's beaten down. It's getting hit hard now. But if it turns around, again, these aren't buys right the second, but they are pulling back. They're doing what Roger just described, where there's 2 ways for the stock to pull back. After a big move up, it goes down or it goes sideways. These biotechs that are out of favor, they're just pulling back. So what I'm waiting for now is not to buy the dip, because you don't know how long the dip goes, is that what I do is I buy the bounce after the dip. So I'm watching these stocks that have been out of favor, that are consolidating, which is perfectly normal, perfectly healthy, and nobody's paying attention to them right now since they're out of favor and they're pulling back. Wait, because when they start bouncing, you'll see them just take off like an airplane just rocketing higher, or a rocket ship rocketing higher.
Mm-hmm. And Jeff, what have you got in the way of defensive stocks and also opportunities in the near term?
Sure. What I would say is just out of some concern regarding the momentum aspect of this tailing off, especially after Labor Day. As you're saying, to stay defensive and basically look for places and parts of the market that have not really participated much in the rally. And I've said this for a few weeks now, I like the cruise line stocks. This is in keeping with what Roger was saying about this anticipation. It's my feeling anyway, as anticipation grows towards COVID-19 becoming a manageable situation, as opposed to one that has at least been made to sound like it's unmanageable. I think we see more money moving into cruise line stocks. The airlines started moving up last week. Financial stocks haven't really moved yet, but to me, when I look at the chart, to me it looks like they're coiling and getting ready to move higher. And I think you go towards those areas, buy, and this is obviously a longer time frame, but buy what's cheap. Because, in a handful of months, regardless of what happens, say 2 or 3 weeks from now, or in the next couple of weeks, that's where the money's going to go, to where assets are still inordinately cheap compared to pre-COVID.
Mm-hmm. Okay, and Roger, what do you think we should be focused on this week?
I'm focusing on the exact same stocks that I've been focused on for the last month and a half. Nothing changed. Basic materials, industrial, and shippers, FedEx, UPS, the freight shippers, the software as a service stocks, and the industrial and basic materials, and the online retailers like Lululemon. Gap is getting a lot of exposure, but basically the same thing I've been focused on a month. Those narrow focuses. I'm not focused on real estate yet. I'm not focused on financials. I'm not focused on really on healthcare right now, but I am focused on subsectors, and those are the ones, and also metals. As you know, I'm watching gold and silver very carefully. I'm actually becoming more interested in silver than gold, but their correlation is so tight. I'm not seeing. Depending on what you're comfortable with, but those are the sectors that I am focused on.
Okay. Just quickly, you also were rather bullish on a company called C Corporation a few sessions ago, and I started tracking it, and it's now up 880% year to date. And I was really quite astonished, because it's not really in the mainstream dialogue at this point. I just wanted to inquire, are the fundamentals surrounding that company still solid, or is it the technicals that are driving you? And are you still enthused about it?
Well, before, it wasn't the technicals or the fundamentals. It was the 13F filings. That's how I found that stock. And looking at it this quarter, it looks like the accumulation on that level is still continuing full strength. So I am continuously bullish on it.
Okay, great, gentlemen. Well, that's another roundtable for the last day of the second quarter and the last day of August. So thank you all very much. I'll look forward to speaking with you individually throughout the week and for next week's roundtable. Have a great trading week, and we'll see you all soon.